the input price, the crude oil prices being on the higher side, has weighed down heavy in terms of their earnings performances as well. Let's discuss all of this and more and talk a little bit more about the sector. We're joined in by Harit Kapoor from IDFC Securities to take us through what's been plaguing the sector as a whole. So two big numbers that came out, Asian Paints, Kansai Nerolac reported numbers. What's your sense, Harit, on how to approach this sector and space now?
Yeah, hi, good afternoon. So if you look at the results which have come out yesterday and the day before for Kansai and Asian Paints, I think a couple of things are very clear, that the pain of the higher crude as well as the rupee depreciation has started to hit paint companies severely from Q2 onwards. The challenge really has been that post the GST tax cuts, companies were hesitant to take price increases immediately, as they would, they were fearing that they would come under the anti-profiteering lens, and hence they've had to delay their price increases. The first of them has come in October on the decorative side. From 1st October, price increases are to the extent of about 2.5%. The way we look at it going forward is that we believe that though in the near term, margins will be under pressure, but sequentially we expect margins to improve as price pass-throughs start to come into the space. And we believe the October 1st price increase is the first of many, as companies start to pass on with a lag the pressure not only from crude prices but also from the currency depreciation, which affects their imported raw material cost.
Is there a change in the demand for home improvement as a sector right now, and whether or not we see a dip going forward in spending within this category?
So if you look at the volume growths for the two companies that have reported so far, Asian Paints and Kansai Nerolac, on the decorative segment side, you've seen double-digit volume growth continue even in Q2, and this is in spite of a shift in the festive season to an extent. As far as the commentaries go, demand seems to be stable on the decorative paint side. However, on the industrial paints side, which includes auto and general industrial coatings, there is a bit of a weakness in demand which could affect the paint companies. However, if you look at the skew of industrial paint share, Kansai has a higher share versus Asian Paints, and Asian Paints' share on the industrial side is quite low at about 10 to 15% of the overall revenue mix. But if you look at overall consumer demand, it's fairly stable as of now, and going into Q3, which is the festive season, initial signs are that there is no real reason for concern in terms of lower demand or so. So we are factoring in a stable early double-digit volume growth on the decorative side for the paint companies.
Would you see a meaningful difference in the retail side versus the industrial side at this current juncture? I mean, if you're taking a look at Asian Paints and Kansai and the different spaces that they're more prominent in.
Yes, so there is a difference between the decorative and industrial side on two counts. We feel that in the decorative segment, the volume growth is more stable and it is more consumer demand led. The industrial volume growth is more B2B led, and it is a function of how the user industries actually operate and what their demand is. Also, as far as price increases are concerned, it is easier to pass through price increases on the decorative segment as compared to the industrial segment, as the industrial segment is a more B2B segment where the negotiations happen over a period of time with the buyers, and the price increase happens with a greater lag as compared to the decorative segment where companies just pass on the retail price increases faster. We believe in a rising crude oil environment or a high crude oil environment, as well as in a scenario where currency has depreciated, it is better to play companies where the share of decorative paints is higher. Hence, we believe the Asian Paints is the best play in the paint space currently, given their pricing power leadership, as well as the fact that their skew to the decorative segment on the revenues is far higher than the other players.
Just one small question. Conversations with people in the real estate industry seem to suggest that the metros, city like Mumbai, etc., have a glut of real estate supply ready, which might, at least in the luxury segment and the upper middle class segment, which might not see enough sales. Now my question is, do you reckon that a company like Asian Paints, which is more premium in nature, could face that issue cropping up in the next 12 months, that demand which was hitherto robust in the luxury segment and upper middle class segment will see a bit of a tapering off, and that might impact volumes?
Yeah, I agree with the fact that the premium segment on real estate could be under stress. But if you look at Asian Paints' business, we believe that the project sales business, which is the new construction-led growth for Asian Paints, is a very small proportion of their overall decorative sales. In fact, the bulk of the growth or the bulk of the revenues for Asian Paints, or for that matter the industry, comes from repainting demand. It's basically consumers repainting their houses. So we don't believe that there is a huge impact on account of that, which is likely. Also, if you see, the bulk of the growth has come in tier 2, tier 3 towns anyways over the last 2 or 3 years. Metros have literally grown slower than tier 2, tier 3 over a period of time. So the fact that project sales, which is new construction sales, are a very small portion of the overall sales for these companies, and the fact that the demand centers have anyways been more tier 2, tier 3 led as compared to metro led, we believe the impact, if any, will be minimal going forward.
Okay. We haven't spoken as yet about crude, though I must admit it's no longer at 85 and therefore loses its relative relevance in that sense. But how big a factor would this be over the course of the next quarter, at least, if not more?
It's a very large swing factor. If you look at from Q1 to Q2, there was a significant inflation in crude, and if you see paint companies, they suffered on account of that. As you come into Q3, with crude oil prices actually coming off by more than 15% from their peak, close to 13% from their peak of about $86, $87. There is a respite which will happen to, in terms of margins for paint companies if they stabilize at these levels. If they stabilize at these levels, you will see the sequential benefit of that, probably not in Q3, but in Q4, as the inventory, impact starts to, low cost inventory impact only starts to come in from Q4 onwards. On the price increase side, as I said, October, there was a 2.5% price increase that was taken. We believe that there will be more price increases to follow. And as price increases follow, and if crude prices don't go up from here, the margin, the recovery of margins will be that much faster, which will lead to a better earnings growth outlook in the near term.
So Harit, we haven't seen Berger come out as yet, but with the information that you have at hand, what would the overall stance on the paint space be? And if you can share your pecking order, what would that be?
So we believe over the longer term perspective, the paint industry is a very attractive industry given the penetration and premiumization potential here. Hence we believe that the top 3 paint companies will be the largest beneficiaries of this growth in penetration and premiumization. Further, the cut in GST rates from 28 to 18%, drives incremental share gain to the organized segment, which is anyways large in this space, but it just exaggerates that impact. So we're positive from a longer term perspective, as we believe that stable volume growth as well as pricing power is there in this segment. We believe that, as I said earlier as well, given the current scenario of rising of commodity prices at high levels and currency also playing spoil sport, we believe the best play in this space is Asian Paints, given the fact that its skew on decorative is very high. It's the market leader, and pricing power is in their hands, at least on the decorative side. For Kansai, our understanding is that the share of industrial is a little over 40%, and for Berger the share of industrial paints is over 20%, is what our understanding is, and we believe Asian Paints' skew is much lesser than that, and it allows it to gain back the lost margin as well as drive steady volume growth in a much more easier manner over the medium term. Hence, we prefer Asian Paints in this space.
All right, Harit, we'll leave it at that. Thanks so very much for joining us. Really appreciate you taking out the time and giving us your perspective on the paint space as a whole.